This middle ground tends to work the best for many clients, particularly given the uncertainty of what might or might not happen in the future with the estate tax laws. So what I want to talk about today is what potentially the tax law changes that are coming and how clients are reacting to it currently. There's an amount we call the estate and gift tax exemption. It's the amount that you can leave tax-free at death or you can pass during your life as a gift. And that amount's been steadily going up for years and years and years. When I first started practicing, it was $600,000. Today, it's almost $14 million. So the amount that a person could die today and pass tax-free is 14 million, round numbers, or could give away. All those increases have passed over the years, and it just keeps going up. And when Trump was elected in 2017, the amount was 5.5 million, and the Trump tax cuts doubled it, so it went up to 11 overnight, and it's gone up through inflation to get us where we are today at about 14. Unfortunately, the Trump tax cuts expire at the end of 2025. So in about 18 months, when they expire, that amount, the tax-free amount, will be cut in half. So it'll go back down to around 7. So a lot of people are really concerned that they're going to lose this exemption, this extra $7 million, and that'll cost their family whatever the estate tax would be on that extra 7. What I want to be clear, because there's a lot of confusion. Clients call me every day and they're like so worried about this. You don't owe any tax when the tax law changes. It just means the rules changed. If you happen to die in 2026, your exemption will be $7 million. If you live for another 25 years, who knows what the rules will be? They change constantly as they're changing now. So it's not the panic that some people are reacting to where they feel like I've got to do this or I'm going to owe some huge amount of tax. It's possible that they may owe more tax. It's also possible that they extend the Trump tax cuts. They talked about that in the debate the other night. If the Republicans win, they've said they're going to extend the Trump tax cuts. If Biden and the Democrats win, they said they're going to let them expire. Chances are we'll be somewhere in the middle. And since Clinton was president, every year, every time this has come up, they've extended it. So when he was president, they extended it. When Bush was president, they extended it. When Obama was president, they extended it. And when Trump was president, they increased it. So there's a chance that nothing happens at all. But it's important for people to know what they can do. And I've talked a lot of clients out of doing what we're about to talk about just because it didn't make sense financially. The only way to take advantage of this higher exemption, this $14 million exemption, is to use it before it changes. So what is possible is someone could say, I'm going to go ahead and give $14 million of assets away right now or sometime before 2026. That's easy for me to say, but for a lot of people, that's impossible. They either don't have that much money, or if they gave away that much money, they wouldn't have enough money left over. If you're a married couple, you can do both $14 million exemptions. So you could actually give away $28 million, estate and gift tax free, and that would be out of your state forever. Again, unless you're very wealthy, it'd be really difficult for most people to do that. I have clients who have, tens of millions of dollars and they can afford to make that gift, and they're planning on doing so before we think the law will change. But I have a lot of clients who call me who are, probably not in a position where they could comfortably do that. And it all depends on, how much your net worth is and how much your spending rate is. So it's different for everybody, and their age, how long they have to go before they pass away. So I try to work the client through, does this make any sense financially? Because it may make sense to do for estate tax purposes, but it could also put them in a terrible financial burden. If they've got hundreds of millions of dollars, presumably they won't blink in making this kind of gift. But if they have, $30 million and they give away 28, that's probably not possible. There is a type of trust that a lot of my clients are looking at as a means for making this gift where it's not as painful financially. They call them spousal lifetime access trusts. It's just a trust for the benefit of your spouse. So let's make up the example. Couple comes to me, they have $30 million, and they say, we want to take advantage of our $14 million exemptions, but we really can't afford to give that much money away to our kids. So what's possible is they could create trusts for each other. Husband could create a trust for wife and put $14 million in that trust. Wife could create a trust for the benefit of husband and put $14 million in that trust. Now their net worth is $2 million. They've given away $28 million, and that will never be subject to estate tax. Not only the 28, but all the growth on it. But what they've done is they've kept access to the money. Husband has access to the trust that wife put $14 million in. Wife has access to the trust that husband put $14 million in. So at the end of the day, when the dust settles, they still have all $30 million accessible to spend and use. However, if one of the spouses were to die, that spouse's trust would no longer be accessible to the spouse who created it. In other words, husband puts $14 million in a trust for wife. She has access to it. He indirectly does, but if she dies, he loses access to that money. It typically would roll on down to the kids. And so he'd only have access to the $14 million that she put in trust for him and the $2 million that they didn't gift. So he went from about a $30 million accessible net worth to half that because his spouse died. And of course, you can't predict when people are going to die. So while I get a lot of calls from that exact fact pattern, most of the couples that I talk to in that fact pattern, after I explain that they could lose access to half their money, back off doing that because it's just too risky unless they're certain that they can live on half their net worth. And if they're older, if they don't spend a lot of money, maybe it makes sense to do that. But you really should think hard about doing a gift of that magnitude with a net worth that's sort of small, if you will. Now, there are other ways to reduce your estate tax. So what I end up seeing is a certain group of clients who say, there's no way I can do any of this. I have some clients who are happy to give away the $14 million each. And then I have this group in the middle, like the theoretical client that I described who has $30 million. And instead of them giving away $28 million, what we talk about are other ways to reduce their taxable estate as it goes forward. Because one of the issues is it's not static. Presumably they're investing that $30 million and it's growing, and someday it'll be $40 million and $50 million. And that growth is going to be subject to the estate tax. So you have two problems. You have the loss of the credit, but more importantly, you have a continually increasing estate that's going to be subject to a 40% estate tax. So what I like to focus on those clients who aren't prepared to give away a bunch of money, but are interested in reducing the ultimate estate tax, is we focus on trying to give away that appreciation in the estate. So imagine if you went to a bank and you borrowed $1 million and you bought a house. When the house appreciates and you sell it, let's say for $1.5 million, the bank says, you just have to give us our $1 million back. You get to keep the $500,000 profit on the money you borrowed. Well, clients can do the same thing with these types of trusts. They don't have to give money to the trust. They can loan money to the trust. So again, go back to my couple, say they've got $10 million in the stock market. And they say, Tony, this could become 12 million, 15 million, 20 million. And all that excess growth is going to be subject to estate tax when they die. So again, husband can say, I'll create a trust for my wife. I won't give it that $10 million stock portfolio. I'll loan that portfolio to the trust. The trust has to pay me back the $10 million. So my net worth's not changing at its current level. But if just like the house that you bought when you borrowed the money from the bank, if the wife's trust appreciates to $15 million, that $5 million of appreciation is in the trust, not part of the estate anymore. It's out of the estate. Yes, the spouse has access to it directly, so that's good. If you need it, you have access to the appreciation. If the spouse dies, prematurely, that $5 million is going to pass on to the kids, but it won't affect your current net worth. It's only the increase in value in your net worth that you're giving away. I like to refer to that as an estate freeze. We're trying to freeze the growth in your estate so your tax problem doesn't get any worse. And so that's a very popular technique for clients after I explain their options of doing nothing or being very aggressive and giving away lots of money. This middle ground tends to work the best for many clients, particularly given the uncertainty of what might or might not happen in the future with the estate tax laws. So that's what I've been talking about clients with recently. It's going to become more and more of a drumbeat as we get closer to the election in terms of what might happen. And a lot of people are going to sit back and see who wins the election before they make any of these decisions. My only advice is get in touch with me or somebody like me now to sort of plan for what you might do under the circumstances. Because if the Democrats do sweep, all us estate planning attorneys will be very, very busy for the next year anticipating a change in the estate tax law.